Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 10 and the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Right, so 10-3, it says here the issuance of stock for cash and non-cash assets. So issuance of stock, right, for cash and non-cash assets. This exercise shows the similarity and the difference between two ways to acquire plant assets. So we're acquiring assets. So in case A, issue stock and buy the assets in separate transactions. So Apex issued 10,000 shares of its $10 par common stock for cash of $600,000. In a separate transaction, Apex purchased a building for $475,000 and equipment for $125,000. Journalize the two transactions, right? And then B, it says issue stock to acquire the assets. Apex issued the same 10,000 shares at $10 par common to acquire a building with a fair market value of $475 and equipment with a fair market value of $125. Journalize the single transaction. And then compare the balances in all accounts after making both sets of entries. Are the account balances similar or different? Okay, so for case A, Apex issues 10,000 shares, okay, of $10 par common, right? So that's 100,000, and they're issuing it for cash for $600,000. So we have 600,000, and the par is 100,000. So our paid in capital is going to be in excess of par, is going to be 500,000, right? So the journal entry is going to be a debit to cash for the 600,000 because that's what we're receiving, right? We're going to credit our common stock for the 100,000, and we're going to credit the paid in capital for the 500,000. Now they're going to take that. It says they issued the stock for cash, so they've received cash. In a separate transaction, right? Separate transaction, Apex purchases a building, right, for $475 and equipment. So we're going to debit building for $475, debit equipment for $125 in cash, and credit our cash for the 600,000. Okay, so basically what they did was they said, okay, we want to we're going to issue stock, and the cash that we get from the stock, we're going to buy those assets. Now in case B, it says Apex issued 10,000 shares of its $10 par common stock to acquire a building with a fair market value of $475 and equipment with a fair market value of $125. Journalize the single transaction. Okay, so when as a quick aside, just so you can see this, notice what we have here. If we look at these two transactions here, okay, we have a debit to cash for 600,000, and we have a credit to cash for 600,000. Okay, well, if we combine the two entries, all right, basically we end up with a debit to building, debit to equipment, and then the credit to common stock and the credit to paid in capital. Okay, it's sort of like accounts payable or accounts receivable, right? And I'm going to write that, do this over here. If let's just use an accounts receivable. If I debit accounts receivable, right, and I credit my revenue, right, and then, so I have an accounts receivable, then when that person pays, right, I'm going to debit my cash and I'm going to credit my accounts receivable. Okay, so what ends up happening? My debit to accounts receivable washes out the credit to accounts receivable, so I'm left with the debit to cash and a credit to my revenue, as if I had the same, I made the sale in cash. All it took was two different steps here, whereas if they just pay cash, it only takes one step. Well, this is the same exact kind of thinking, okay? All right, so that's a little bit of association, all right? This is not like something new, right? This is something you're already doing, all right? So here, if we look at this, okay, where if we issue the shares, we still have the credit to the common stock for the 100,000. We still have the credit to the paid in capital for the 500,000. Okay, we're buying the building. Okay, so if I was doing this journal entry and if I ask myself, if I go through the thought process, am I affecting cash? No. Am I affecting accounts receivable and accounts payable? No. Then I do what I know best. Well, if I know I'm buying a building for $475, and I know I'm buying a equipment for $125. Okay, so that's what I know, right? Then debits have to equal credits. Well, what am I going to credit? Well, I'm issuing stocks. So now I go through the thinking process of 10,000 shares at $10 a share is 100,000. So debit the common stock for 100,000, and I'm because I am paying, since I have the 100,000 here, and my debits still have to equal credit. My debits have to equal the credits, so then I can just literally back into the paid in capital amount, okay? Whereas in the first transaction, we actually calculate it, we know how much cash we're actually receiving. Well, since we're not receiving cash, how do we decide how much the paid in capital is? Well, the paid in capital is determined by whatever our purchase price is. I mean, if this was 500,000 and 150,000, that's 650. This would become 550, right? So because we're just backing into that amount, okay, based upon the selling price of whatever our purchase price of that asset is. But like I said, if you looked at it from, if you take these two transactions, and as you wash the cash aspect out, right, what we're left with is that same transaction. But if you didn't see these transactions and you had it work it this way, you sit there and say, okay, I'm buying a building, I'm buying equipment. Okay, what's the par value of my common stock, right? So this is like step one. What's the par value of my common stock, step two. And then number three, I back into this amount because I have to take my debits, make my debits equal my credits. If I have 600,000 in debits, 100,000 in credits, then my paid in capital has to be 500,000. Okay, I hope that was easily understood. Okay, so now, excuse me, it says here, compare the balances in all accounts after making both sets of entries. Are the account balances similar or different? Okay, well, if we look at it, and I'm going to squeeze this over here, we're going to have our building, right, which is going to be 475. We're going to have our equipment, which is going to be 125. we're still going to have common stock at 100,000, and we're going to have the paid in capital in excess of par at 500,000. Okay, so they're all going to be the same, regardless of whether we do it this way or we do it this way. Okay. All right, so that's it for this exercise. If you didn't understand it, watch it again. Go back and watch the theory videos, and if you still need help with the theory and you're not understanding it, feel free to contact an instructor.